If you've ever invested in the trade desk, then you've certainly been on a wild ride. This company from IPO to all-time high did nearly a 5,000% return on investment in the space of less than a decade as well. But since then, they have had a huge haircut, to say the least, and the stock has crashed 60% from their all-time highs. You can see the massive increase in volume here when the trade desk fell short on their expectations for their Q4 results reported recently. 60% from all-time high to current share price isn't great. And this is what happens when stocks are priced for perfection, right? The trade desk before this massive crash was trading at 70 to 80 times forward price to free cash flow, with pretty much optimized free cash flow margins as well of about 27%. It doesn't get much better than that. And that's what happens, right? Like if the stock or if the company reports something that investors aren't expecting on the adverse side, then you can see a huge crash in share price. And obviously it begs the question, because this company has done so well historically, and now the valuation is much, much better than what it was before, is it a buy at these levels? You can see from a base case DCF that I did that, if you put the trade desk's forecasted growth between 14 and 20% over the next 10 years, I've also just noticed that there's a mistake in the expected years going forward, but that doesn't affect the numbers. Just imagine FY24 says FY25 and so on and so forth, up the way to FY34. We're getting a fair value of $62.62 per share, and that's maintaining the midpoint of their free cash flow margins, which is about 27%. So you are getting a slither of upside. And I've followed this company for a long time, and I've never seen a slither of upside on a DCF model like this. So am I bullish on the shares, trading at now 35 times forward price to free cash flow, which seems very, very reasonable. And if you look at their multiples, let's look at price to revenue and also forecasted price to free cash flow, you can see that the ratio is very, very low compared to where they traded at historically. So am I buying? The answer is no. It goes back to qualitative long-term thesis in the company. I wanted to point out a risk that not a lot of other people are pointing out, and I could be wrong. I'm not an expert in the advertisement space. If you're making a mistake, you'd rather not invest in it and then, okay, it turns out to be good, and then there's some cost of not investing in it than, jumping in saying, here's a business still growing high teens at 35 times cash flow. Was Wall Street incorrect? Was the stock market incorrect, valuing it at this higher multiples for the whole of history? And then it turns out to be wrong. I would obviously rather be in the former position. And I'll explain what I think is going on here, which is certainly not what's going to happen, but is certainly a big risk for the trade desk that I think a lot of investors are underappreciating, and certainly those investors that have invested close to all-time highs are underappreciating. So let's just talk a bit more about the trade desk's business model first. They're a demand-side platform for advertising, right? So what does that mean? I'm a business. I want to advertise. There are a whole range of places that I can advertise online, and I go to the trade desk to help me bid, buy, manage my ads. That's what they do. So if I'm a business that wants to advertise, their customers are advertisers, right? And the trade desk have the most comprehensive platform for buying this ad space. Now, an advantage the trade desk have got, because obviously the majority of advertising market share on the internet these days goes to a handful of companies: Meta, Google, Amazon, TikTok. These companies have obviously the majority of the market share, and Google, and I think Amazon as well, they have tried to build a product very similar to the trade desks. The problem with that is there's a huge conflict of interest, because let's say Google is saying, here are all of our vendors selling their ad space, we'll bid for you. There's a big conflict of interest, because if Google then recommends a third party to the advertiser, they're only going to get an 18 to 20% cut. And that's roughly what the trade desk's cut is. If they then say, it's best for you to advertise on Google or YouTube, then obviously Google are going to make that money. And there's a massive conflict of interest, because that's how Google make most of their money. Advertising is one of Amazon's highest margins and fastest growing businesses. So there's a massive conflict of interest there too. So the problem with that is that's where the trade desk carves out their niche, because they can actually be in the best interest of advertisers and provide this all-in-one suite. The problem then becomes is it's not really an all-in-one suite, because Meta, Google, Amazon, they are what the analysts would call walled gardens. What that means is they do not let the trade desk bid and sell their ad space. Why? Because the trade desk take that 18 to 20% cut. And also it's data. These companies have the most powerful data in the world, right? And they don't want the trade desk getting their grubby hands on their precious advertising data, because they are technically competing against the trade desk a little bit in that regards. Because when I'm trying to advertise, I have to choose, okay, am I going to go to Google? Am I going to go to Meta? Or the trade desk, which they monitor ad spend or ad platforms where they don't have a closed system. So a lot of the smaller players that don't have the scale to run their own advertising business, maybe you're a smaller streaming company, half of the trade desk's revenue comes from streaming. And you're a smaller streaming company, let's say Warner Brothers Discovery, right? They don't have a walled garden. The trade desk helps them by listing that ad space. Then advertisers can bid for it. They can find the best match for that ad space, right? Warner Brothers Discovery is happy because it doesn't have to launch its own organic ad business. Or there might be a hybrid approach where at least the trade desk can do a lot of that bidding for them, and the people that are advertising are happy because they don't have to communicate with a whole load of vendors. But the problem that I am seeing is, and this is my real issue with the trade desk, the way the world is working in the 21st century, right, is we're in a winner takes most world. Meta has taken most of social media. Google has taken most of search. I'm sure whoever wins the large language model race will end up taking most of large language model, because it's a very similar-ish business to search, generalized large language models, right? Google ended up taking most of search and has pretty much controlled 90% of the market for the last 15, 20 years. Uber has taken most of rideshare. Spotify has taken most of music. And the problem with that, all the companies aforementioned, they operate these walled gardens. So the trade desk cannot list the ad space from these companies on their platforms. And that's a real issue. Obviously, the trade desk has been around for a long time and has done very well. But I think where then the issue comes, because this is all about data, in the future, now, well, it's not just the future, right now, artificial intelligence, right, is growing exponentially. And what AI is doing is it's helping these big tech companies process their data and analyze their data in an infinitely more effective way. The ROI on ad targeting grows exponentially as well. That's the problem that I see. It's this data set, this superior data set within Meta, within Google, within Amazon. We've all seen ads getting more targeted, more efficient. It's not just, oh, I'm a 26-year-old male and I like to be outside and do sports, and then I get an advert for a tennis racket. It's much, much more specific than that. And it's getting more and more powerful all the time. So those are the 2 points. It's like, number one, we're in a world where over the long term, one or two businesses, but in many of the industries I mentioned, one grabs a whole load of market share, takes the majority of the market, and then what do? They become a walled garden, because they're not going to have the trade desk coming in to bid for that ad space, having access to all of this data, which literally makes them their money, right? Like, advertising is Meta and Google's largest revenue business. They're not going to have the trade desk come in, potentially have access to that data and take an 18 to 20% cut. And quite frankly, they just don't need it. I understand that advertisers want to advertise on a multitude of platforms, but the problem is that trend seems to be that all of the best platforms are segueing from open internet towards walled gardens. Yeah, like Uber, for example, a company that's one of my long-term holdings, they've started their own advertising business. So I noticed an advert when I was on a ride a few weeks ago, and they have immediately gone for a closed loop. They're in their walled garden because they literally just don't need the trade desk coming to take a 20% cut. And the problem is that AI is going to make Uber's proprietary data set infinitely more valuable, i.e. like 20 or 50 times more valuable than Lyft's, which not only accelerates Uber's dominance in terms of market share because they have more data and then they can react to that data and be more efficient, but it also means that the ROI of ads is better. So the companies that have got the best data will produce the highest ROI on ads, but the companies that are also doing that are walled gardens, right? Because they can afford to be walled gardens if they don't need the trade desk. And what happens is you kind of then have second grade advertising that you can get on the trade desk. And that's where I worry. I'm not saying it's a bad business inherently. I'm just saying I've built a DCF which is still projecting, 14% growth out to 2034. And I'm just not sure in 2034 we'll be living in that world. There is a big problem where it's like, let's say as an advertiser, I wanted to advertise on Meta, Amazon, Spotify, Uber, all of these like A-grade companies that have taken most of the market share in their industries. I actually have to go to each one and run ad campaigns on each one. But that's just the way it is. Like, these companies want to control that piece of the pie. The trade desk doesn't get access to that. The trade desk has apps on it. For example, I used Strava recently. The trade desk would have access to something like Strava. Their largest segment is connected TV. And the thing about connected TV is it's not a consolidated industry yet. It's a fragmented industry. You have all of these apps. This is why Roku exists, right? You have all of these streaming services all trying to grab market share. The industry hasn't consolidated, or it hasn't consolidated yet. I mentioned Warner Brothers Discovery recently, right? It was a merger. That's the problem, is like, I think this industry will start to consolidate, particularly when consumers do not want to pay for like 6 or 7 different streaming apps. That's a whole load of money. That's $100 a month. If we're talking about recession, streaming apps, excess streaming apps are some of the first things that people cut. Exactly the same as what else do they cut? Advertising spend. And if I'm a large company and I have to choose advertising spend between, I can analyze on Hulu and I can analyze on some gaming app or some weather app or something like this, or choosing the walled gardens, which I can't do through a trade desk, Google and Meta and Amazon, the people that have all of this superior data, now it's going to be AI driven and now those ads are going to be infinitely better. I would choose that. I absolutely would. Like, maybe the trade desk is a good secondary option, but I think that then the trade desk becomes a leverage play on advertising. It's even more cyclical than advertising, because if I had to choose one, I wouldn't choose the trade desk. And it's also a risk that, 50% of their revenue comes from the connected TV side of it, but also that industry is consolidating, as I mentioned. And guess what? Like, at the top of that industry, you've got Netflix, which is a walled garden. I mean, they only started advertising properly in 2022, but they're a walled garden. And then obviously you've got Amazon Prime, which is gaining market share rapidly, the TV segment. They're a walled garden. And then you've got YouTube, that's owned by Alphabet, which is probably the largest method of watching online content these days. And they're a walled garden. So that's my worry with the long-term business. It's not that it's a terrible company. The CEO, Jeff Green, he already ran a business before, an advertising business that he sold to Microsoft in 2007, made a load of money, and now he's doing it again. He owns a whole load of the company, and I'm sure he's exceptionally capable. So I don't want to sit here and disprove what the trade desk are doing. I'm just saying that given that I see this risk, which is going to be accelerated by AI, so AI will accelerate A, consolidation, and B, accelerate ROI on advertising, but because the walled garden companies have a superior data set, the ROI on walled garden advertising will accelerate faster than open internet advertising, and the trade desk can only bid for ads on open internet advertising. Over a long run period, I just think that puts the trade desk in a bit of trouble, and I'm very much in the camp that AI is going to grow exponentially, and that factor makes me see artificial intelligence as more of a headwind than a tailwind for the trade desk. Of course, this is to do with price as well. And if the price came down and there was more of a margin of safety there, I'd absolutely consider it. But it's just very interesting to see a company go from ultra euphoria to almost ultra bearishness. And we'll see from here if the stock can hold up or if it continues to decline.